Welcome back to the Teaminvest Wealth Builders podcast, where we help you make smarter decisions about your wealth, your business, and your future. I'm Kerry Fleming, and today we're diving into a hot topic that sparked plenty of debate in financial circles: active versus passive investing. Whether you're a seasoned investor, a business leader, or just starting to take control of your financial future, this episode is packed with insights to help you navigate the pros and cons of both strategies. We'll break down the fundamental differences between passive investments like index funds and ETFs and active management, where fund managers make high conviction decisions to try to outperform the market. We'll also explore how fees and compounding returns make a huge difference to your long-term results, what to look for when choosing a fund manager, why not all active and passive funds are created equal, and the common myths and marketing messages that can trip up even the most experienced investors. Plus, we'll share real-world examples, industry stats, and takeaways from the recent ASA conference panel. So if you want to understand how to build wealth that lasts, avoid pitfalls of selective marketing, and choose the right investment strategy for your goals, you're in the right place. Let's get started.
So Andrew, recently you did a panel at the ASA conference and you were invited to talk about active versus passive investments, and there was a bit of a debate with the other panelists there. And I thought that's really an interesting topic that we should expand on a little bit more. And maybe we start talking about the passive side of it. So in terms of a passive investment, what makes a good passive investment, or is there a good passive investment?
Yeah, I think, Sanjee, the first place to start is what is an active strategy and what is a passive strategy? Because I think before we talk about the successes and failures of each, it's worth probably defining what we're actually going to talk about. So really, from a fund manager point of view, a passive strategy means holding an index or some other purely quantitatively developed methodology that is unrelated to looking at what you're actually investing in. So for example, owning the S&P ASX 200, that is a passive strategy. You own the index, the 200 largest companies. As the index changes in weight, so too does your portfolio change in weight. And the fund manager is really, in that case, passively tracking someone else's work. That's why it's called a passive strategy. On the other hand, an active strategy is where the fund manager is making decisions of themselves. So they're deciding what to put into the bucket. And there are versions of active and passive. You know, there's passive aligned, which means it's mostly the index, but with a couple of changes. There's high conviction, which means it's a relatively smaller bunch of assets that you care about and you think are really good, holding, say, 20 assets or 30 assets. And there's everything in between, right? But really, that's what we're talking about here. We're talking about passive, meaning no brains were harmed in the creation of this portfolio, and active, where in theory, the person you're paying to do the work has put some work in. Now, we can argue whether they've done a lot of work and how many brains were harmed in that one too, but at least in theory, that's what you're paying for. And I suppose why this debate has become so particularly important is that over the last couple of decades, or the last 20 years, the amount of money that has been managed by passive funds has moved from a very tiny portion of the market to well over 50% of the money that is now.
It's been quite a lot.
Absolutely. And they're, you know, Vanguard, BlackRock, Morningstar, the industry super funds, etc., have all pushed for this passive investment strategy. And the logic behind it goes as follows, which is, I think, to the point that you wanted to get at. We know from research that roughly 97% of day traders fail to make money. They lose money.
Yeah.
And 80% of active fund managers fail to beat the index after fees. So why would you want to pay someone to get a bad outcome for you? That's the logic.
Yeah.
And of course, it's been, you know, improved over time by misquoting people like Warren Buffett, where he talks about, for the average investor who's not prepared to put work in, you'd be better off owning the index. His point there, of course, is for the person not prepared to do the work. But, you know, you can just quote that as you're better off holding the index, and then that becomes a nice little journalist article. But really, what it boils down to, I think, is that great line apocryphally of Benjamin Disraeli from the 19th century, the English Prime Minister, of there are lies, damned lies, and statistics. And it reminds me so much of the brilliant campaign by the food and beverage, particularly junk food and beverage industry in the 90s and early 2000s, to label things 90% fat-free. Yeah, 10% fat, which is actually huge fat content, but no, it's 90% fat-free. And to me, it's the same thing here, because those stats sound like an indictment of active managers, but they're not because you haven't asked the inverse. Because no one in that stat bothers to ask what percentage of fund managers that are passive beat the index after fees, which of course the answer is 0%. And it's got to be 0%, and it's guaranteed to be 0%, because by definition, if you are holding the index and charging a fee to hold the index, your return is the index less the fees.
Yeah, that's right.
You cannot beat the index if you hold a passive fund in that index.
And I think for the marketing of that, it's been so successful for them.
Brilliantly.
For passive managers to go out, because it is very low cost. It's low cost for them to execute, and it's extremely low cost from a investor's point of view. So if you go out and start selling a product saying this costs a fraction of what an active manager would charge,
and
people look at it and go, yeah, that's great. But what is it robbing you of?
Absolutely. And it's a brilliant marketing ploy, right? Because if you turn out there and you say, if you go into an active fund and there's an 80% chance you won't beat the index after fees, and they're going to charge you 1.5%, 2% for the privilege.
Yep.
That sounds scary.
Bad. It's scary.
Whereas if you come to me, I'm holding the index. I didn't say I'm going to beat the index. I implied, but because I'm holding the index, that I'll get the index, right?
Yeah.
And I'm only going to charge you 75 basis points. The problem is that's comparing apples and oranges, right? You've said the one fails to beat the index after fees. So you've already adjusted the fees, and then you imply to the person, let's double count them. Let's add the fees on top.
Yeah.
And the other one says, before fees, I achieved the index. Yeah, but you don't pay as an investor the before fee. You don't get the before fee return. You get the after fee return.
That's right.
And you can do the maths really simply in your head, right? So ignore the 80-20 for a second. If the index averages 8.5%, which is roughly what the ASX 200 has averaged for the last 20 odd years, and before, but take the last 20 years, and the average passive fund charges a 75 basis point fee per annum, then you as an investor have averaged 7.75% per annum.
Yeah.
Done. That's what you're getting. 75 basis points less than the average of the market. On the other hand, those active fund stats, more than half of the active fund managers, when you compare it to 7.75, have beaten that.
Yeah.
So on a coin toss, you didn't know which active manager you were in. Roughly half of them would have got you better than that.
Yep.
And half of them would have got you worse. So it's not a question of passive beating active. It's a question of misquoted statistics.
Yes.
Followed up by the second question you should be asking, as always, if you're a deeper thinker, which is, which of the funds was I in? Because if I was in one of that half that beat the 7.75, I was probably quite happy. And if I was in one of the half that failed to beat the 7.75, I'm probably upset.
Of course.
And rightly so. But that's not an indictment of active management. That's a question of making sure that you're in the right fund, which is the same as making sure you're in the right passive fund or asset class or any other thing.
Yeah.
But it has been a brilliant marketing campaign. And I think it's been one of the great indictments and reasons why vulnerable people have been so successfully parted from their wealth in terms of income inequality. So it's not that they've lost money, but that their wealth has grown at a much lower rate than the top quartile, because the top quartile doesn't fall for this marketing spin.
Yeah.
They see the numbers in front of them. And the average person who looks at their financial accounts, a couple of hours every few months, to them, well, yeah, 80% of active fund managers fail to beat the index after fees. Why wouldn't I go passive? And you forget the difference. We've talked about this a lot, but 7.75, which was that 8.5 of the index less than the base 75 basis point average passive fee, means that if you had $500,000 to invest and you invested it for 20 years in that fund, you would today have 2.1 million, which sounds sexy. And it's what the industry super funds play every time with that compare. Look at how much money you'd have. What they don't ask is what's the comparison point? Because if you'd gone into an actively managed fund or managed your money yourself and achieved, say, only 12% over that 20 years, you wouldn't have 2.1 million, you'd have 4.8 million, more than double. So the cost of being passive over active in that case was $2.7 million, more than 5 times what you started with.
It's a big difference.
Yeah. And this is the problem with these marketing campaigns and where people fall for them. Because yes, Industry Super, for example, has got this great marketing campaign of talking about, because our fees are less and we own a passive fund, we outperform a passive fund manager with higher fees. Well, no shit, Sherlock, to be colloquial, right? Like if you're getting 8.5 and they're getting 8.5 and you charge less, the investor is better off. And that's a good thing. But that's not the comparison point that's fair. It's not fair to say we are a passive fund and we're going to compare ourselves to everyone else who's passive but has higher fees. What they should be doing is comparing themselves to the other alternatives that investor had, which was an active manager who might have had higher fees, but with a 1 in 2 chance would have beaten
the passive investment strategy.
Exactly. And a few percentage difference makes a big number over time.
I meet a lot of people and they're talking to me about their investments in the funds and so on. And it's amazing that people, when I speak to them and say, okay, so what type of returns you're getting? They say, oh, around 10%. Now, in common, when they show me their statement and what I see, they've actually got about 7.5%. Really, in their minds, 7.5, I'm rounding up to 10. And they think it's okay to round up between 7.5 to 10. It's about that. And the difference is about the same. No, it's actually a very big difference. And, you know, from what you're saying, it's from 12% to 7.5, 4.8 million compared to 2.1 million. So it is a huge difference. That don't make the mistake of not understanding how much exactly you're getting. Don't round it up. Have a look at what the actual return is that you're going to be sitting with, and then stretch it out over a 20-year period and see, okay, how much difference does it actually make to me?
Yeah, absolutely. And look, whether you want to be an active or passive, if I can take it as a broader thing beyond the debate, which was a fun debate at the ASA, right? But if whatever you're doing, there is significant value in understanding it. So, you know, not all passive funds are created equal. And not all active funds are created equal. You know, there are a lot of active funds out there that destroy your wealth. They are bad investments. They are playing high-risk strategies that don't necessarily come off, and they blow up your capital. They're what we would call capital killers.
Yeah.
There are other actively managed funds that are really a passive fund with a higher fee.
Yeah.
Index aware. I'm holding the ASX 200, but in slightly different proportions. They are almost certainly going to end up with a poor result for you because you're paying someone a lot of money to almost lock in the same return that you could get by just tracking the index. But there are good ones out there. And same thing with passive funds. There are certain passive funds that track good indexes, things that you'd want to own. Other index funds that track bad indexes, things that there's probably not a lot of value in owning. And there are people who charge more and less, or, you know, have different redemption rights for the privilege. So as always, the devil's in the detail.
Yes.
But I think there's two things that we forget about in this sort of common financial services debate that really matter. And if I can, you know, reinstate them. The first is we allow people to make marketing statements without asking the inverse.
Yes.
So we allow people to say, you know, 80% of active managers fail to beat the index after fees. And we don't put the other side of the equation up, which is 100% of passive managers fail to beat the index after fees. So theoretically, by that same stat, active managers blow the lights out.
Yes.
Now, is 80% a good number? No, of course not. But it's better than 100, right?
Yeah, that's right.
You know, if you flip the equation, 20% of active fund managers beat the index after fees. 0% of passive managers beat the index after fees. That now sounds like a great case for active management instead of the opposite. The second thing is, though, is that we forget, because we put categories around things, that there is big differences within the category.
Yes.
So as an example, we are a high conviction strategy in our funds and what we teach at Teaminvest. Why are we high conviction? Well, the definition of high conviction in financial services is that you are holding a relatively small number of assets, say sub 40.
Yes.
You call it high conviction. It depends on how I say that as to whether that sounds good or bad, right? Like, oh, they're high conviction. That implies they're taking a huge amount of risk. Oh, they're high conviction. It sounds like they really know something.
Yeah.
Now, the problem with it, of course, if you come back to it, and we did an episode only recently on diversification, is by definition, active managers that are high conviction will not be diversified particularly heavily. Certainly not compared to a passive index fund.
Yes.
That means they will have higher volatility. Yes. But volatility isn't the question you should be asking. The question you should be asking is what's the returns and what's the likelihood those returns beat my other strategy?
Yeah, that's right.
So as an example, we have high volatility in our funds because some years we beat the index by a little bit and other years we beat the index by a lot.
Yeah.
That means we have high volatility because the range is big, but we still beat the index sort of 9 times out of 10.
Yeah.
So as an investor, you're buying a higher volatile product, but you're getting a better outcome. And you should ask the same, that's not a plug for us specifically, but ask the same about any fund manager. This fund manager, what are the number of times in the last decade that they beat the index? And then what's been the average performance if you average that out relative to the index after fees? Because if those numbers are good, they beat the index more than half the time, and the net result is you've ended up with a lot more than if you'd held an index fund,
Yes.
then the volatility probably doesn't matter. On the other hand, if they beat the index 1 year in 2 by a tiny bit, and blow up a huge amount relative to the index every second year, so the average return has been well below the index, well, you probably don't want to touch them with a barge pole.
Yeah.
You know, be a little bit more deep in your consideration of the equation.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
And in general, also, there's a lovely sort of thought that comes to mind, right? And I did my thesis on this back at university, but if everyone out there is being passive, then no one's doing price discovery. Which means that the more people that are passive in the market, the more likely that an active manager will do well. 50 years ago, when passive strategies didn't exist, an active manager was fighting against other active managers to make money.
Yeah.
And it was really who had the best idea. It was hard, but on average, one person ended up on each side of that equation.
Yeah, that's right.
Yeah, one won, one lost. Today, when half the money in the stock market is passive and index tracking,
Yes.
it's not that hard to be an active manager and beat the index. Exactly, because there's a lot of dumb money doing dumb things, not because the people running them are dumb, but because the system they've set up doesn't allow them to engage their grey matter.
Yes.
You're not allowed to. Like in a classic, take an ASX 200 strategy, because it's hilarious, right? If a company's market cap rises on a rumor, then the passive funds must buy it because it's a bigger portion of the index. Because they're buying it, the share price will rise further, which makes the rumor seem true, which means more passive money must buy it.
Yes.
And on the flip side, if a company's share price drops, it is now a smaller portion of the index, so the passive fund manager must sell. Because they've sold, the share price drops further, so the passive fund manager should sell more. So what have you got in both cases? You've got passive managers buying high and selling low. Now, you've got to be a pretty bad active manager to not be able to take advantage of that. If you know your competitor only wants to buy when the price is high and only wants to sell when the price is low, that sounds to me like the perfect thing. I mean, I've been to a lot of travel. You don't go to markets in Asia or the Middle East or anywhere else and say, I'll only buy it when you negotiate the price up and I'll only sell it when you negotiate the price down, right? This has got to be the easiest period to make money as an active manager, probably in history. Now, that doesn't mean you'll get it right every period, every month, every half or whatever. There'll be things that you get wrong, right? The market can, in the words of Warren Buffett, remain irrational longer than you can remain solvent. But right now, to be putting money into passive strategies, not only is it just the flavor of the month, and that's usually a bad thing, be fearful when others are greedy and greedy when others are fearful, but you are guaranteeing mediocrity before fees.
Yes.
And almost certainly you're going to be guaranteeing worse than mediocrity before fees, because there's a lot of active managers out there who've woken up to the game and are looking at it going, so you mean every time a rumor spikes it, you got to buy more, and every time a rumor drops it, you got to sell more? I will just play it. And it's, I don't have a lot of time for how the US runs its markets. I think there's a hell of a lot of problems with their regulation. But if you want to say, why is it that hedge funds are doing so much in the US market right now? I think unethically, but it's not. It's because they know this. They know that they can make up a rumor about a company and know with almost certainty that the share price will drop, because the index funds will have to sell as soon as the momentum starts, and vice versa, make a rumor on the upside and know that they will have to buy. And all these pump and dump merchants and short sellers are making a killing at the moment because of the dumb money. And I would be perfectly okay with that if it wasn't for two problems. Number one, it's clearly market manipulation. It's not beat around the bush. But number two, the passive money tends to be the average or poorer person's money, because it's in things like index funds and super funds. And so really what we're doing is we're transferring wealth from the most vulnerable in society to the already rich. And I have a huge ethical problem with that. But, as Warren Buffett has said a number of times, the stock market is a great device for transferring money from the know-nothings to the know-somethings. And if you know nothing and you want to put your money into a strategy that is so transparently going to buy high and sell low,
I mean,
unfortunately, you're locking in that truism.
well, and by definition, a passive fund really has to do that. You have to buy high and sell low.
Exactly, it's doing exactly what it says on the tin, right? So you can't be upset at the passive fund manager for doing it. That's exactly the product you bought. The question is, did you buy a good product?
Yeah.
You know, I have no ill will when I buy a cheap scarf or something and I go to the rugby and it falls apart after wearing it twice because that's what I paid for. But is that where you should be putting your long-term wealth? It's probably not a great idea, or you may end up like the scarf, pretty threadbare after a couple of cycles.
Because even from I know the passive managers love to quote how cheap they are and how low cost they are. And it is because that's what they do. They do offer you subpar returns or, less than market returns. The active ones, they charge you a little bit more, but how much more is it worth, right? And
that depends on the manager, right?
That's right. So if you have to do a bit of research, do some due diligence, work out whether the manager is capable and has a history of being able to produce, then you can work out, okay, they know what they're doing. I would trust them with my money.
Absolutely.
As opposed to, okay, let's just see and take the average.
Absolutely. And look, let's not pretend that this rise of desire for passive funds has been only a case of marketing. It's also been because the active management industry for a very long time did a lot of bad things.
Oh, that's true.
There were a very large number of players in the active funds management industry for a very long period of time who achieved anemic returns and charged a very high fee for the privilege of losing your money.
Yeah.
As we used to say at Teaminvest, manage your own money well rather than paying someone else to do it badly for you. And there were a lot of them that charged very high fees to do it badly. And it's right that the passive funds in comparison are a better place for your money. If you were in a fund that achieves 4% per annum as a listed equities fund and charges you 2% on top of that, so your net return is 2%, you are far better off in a passive fund.
Yes.
But on the other hand, what the pendulum has swung too far, and it's now gone from the point of saying there are some active managers out there who are taking the piss and relying upon people not having choices and not thinking through things, into far more money going into passive strategies than makes logical sense. And it's only accelerating at the moment. And so, just like you would have been dumb to put your money into the poor fund manager charging a very high fee for bad results, I would argue you are now going to be silly putting your money into a passive fund charging a low fee for also poor results. At the end of the day, it's still poor results. The only question is, how badly did you get fleeced?
Well, that's it. And if you talk about 7.5% returns is the market average over the last 20 years, and it costs you 0.5% to, or half a dollar,
75 to 7.7. Yeah,
but that's what a passive manager is going to charge you. Paying 2% to a good active manager, or 1% or 2% to a good active manager who can actually get you the 12, you can see the difference there already.
Yeah, well, 12% gross, right? Less 2% fee is 10.
Yes, that's right.
8.5% gross, less 75 basis points is 7.75. Like, there's a material difference. But again, it like when you invest in individual stocks, when you look at individual managers, you've got to remember that not all are created equal, and not all are capable of doing the same thing. And sometimes that's not a fault of the manager. They just got bad luck, or, things like that happen. But as an investor, you have the luxury of choosing where your money is. So, I would say, if you have the ability to look into the product,
yes,
you should do so.
Yes.
If you do not have the ability to look into the product, then unfortunately you are at the mercy of the advice you're given, because you're not capable of understanding whether this is going to be in your favor or not. And if you can't spend any time looking at the manager, and you can't spend any time working out is this good or not, then I absolutely fundamentally agree a passive strategy is the right way to go, because you will not get a great return, but at least you won't be fleeced. You won't lose your shirt. You'll get 8.5 less the fees. But no one's making a decision there to try and Ponzi scheme on the money or steal it like a Bernie Madoff, right? On the other hand, if you can understand and do the research into who the active manager is, then why would you want to lock in a mediocre return when you have so many better options out there? But again, that relies upon you being capable of and wanting to do the research to understand it. So, I agree for that. And this is now the argument for passive investing. For the average Joe or who doesn't want to put any work in and is worried that an active manager might steal their money, go with a BlackRock or a Vanguard ETF, lock in a poor return, but you'll sleep easy at night.
Yeah.
But for those who can do the work, either be your own manager yourself, manage your own money, which is my recommendation. But if you can't do that, then go with an active manager who you've met, you trust, and who's got a good track record. Because in the end, it's worth not a few dollars. It's more than double or triple your money in the long run, as we just showed. 7.75% compounded for 20 years is worth 4 times your money. 12.5% compounded for 20 years is worth 9 times your money. And once you get into the 15s and 20s that some really top active managers like ourselves have achieved, you're talking about, 40 times your money over 20 years, not 9 times your money. And that is, I'm sure for most people, a life-changing difference in cash. That doesn't mean it's going to happen every time. As we always have to say, past performance is no guarantee of future performance. But if it's not the best predictor, I don't know what is. It's no guarantee, sure, but if the person has failed for 15 years, they're probably not going to get good in year 16.
Yeah, that's right.
And if a person has got 15 great years, unless something's happened to them, they could have been hit by the proverbial bus or got covered in hubris, which we've talked about before, or, got caught up in weird cults. But the odds are year 16 isn't going to look too much different to the 15 years before.
And we spoke about doing the work and doing a bit of research into it. It's not a lot of work that actually you need to do to get understand whether the fund manager is good or not. You do have to spend a bit of time. You do a bit of work, and the more work that you put into it, the more you understand it. Absolutely. The better you should expect those returns to be, or better you should be able to predict what type of those returns you should be getting. But it's not like it's an ongoing daily job that you have to sit there and follow them.
It's like owning anything, right? What's its past performance? How do they speak about it? Read their annual reports. And if you can, meet management and ask a few questions and look them in the eyes and see how they sound and look. But, I would argue for the amount of money that pretty much every Australian has in super that they accumulate over their lifetime, let alone the rest of their assets, it's a very cheap thing to put a bit of work in relative to the value it creates. Because I think, I don't know about you, but if the average Australian is going to retire with a super balance of about $1 million or whatever the current stat is, the difference between retiring with $1 million and retiring with 10 million is a material difference in your life, in your quality of your life.
Absolutely.
And if the amount of work you had to do for that is a few hours a year, seems like a cheap trade-off. We work our asses off at our jobs to try and accumulate that money, putting a few hours of work into making sure it's managed the best way it can be for us. Seems like a very small cost relative to both the risk of it being done badly, that $1 million isn't $1 million, or the upside, that $1 million is 4 million, 10 million, whatever it is, right? But that's a material change to your lifestyle.
Absolutely. And especially when you factor in inflation and CPI increases over that period as well. What is that $1 million actually going to buy you compared to what it can now? You really want to get that additional kick up.
Absolutely. And it comes back to, I think, one of our first episodes, that idea of the power of compounding. Really small percentage differences compounded for a long time make huge differences in absolute dollar terms. So we're not talking here about small differences.
No.
But even if we were putting that little bit of work in to get 50 basis points more, or 1% more, or 0.5%, 50 basis points, but whatever, it's worth it. When you do the maths, it's absolutely worth it.
Which is why those passive managers have been successful in their marketing, because they show you the difference it can make by saving 0.5%, but that difference is only applied to market average minus 0.5%, as opposed to plus 0.5%.
Yeah, well, as we said, selective marketing, right? I do the same thing. Why compare yourself to people that make you look bad when you can compare yourself to people that make you look good?
Yeah, that's right.
I do the same. I just wouldn't be allowed to.
All right, Andrew, I think that's a very interesting discussion that we had. I hope everyone's got some value out of it.
Thanks, Sanjee.
The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.